The story dominating macro desks this morning is a collision of two powerful forces: the Federal Reserve's decision to hold rates steady and escalating Iran airstrikes, injecting a fresh wave of geopolitical risk premium into markets. The US dollar index, DXY, is sitting at 100.73, down slightly, a remarkable show of equilibrium given the crosscurrents. On one side, safe haven demand from the Iran escalation is propping up the dollar. On the other, Fed pause expectations are capping any real upside rally. The result is a dollar that looks calm on the surface, but is being pulled hard in both directions beneath it. Here are the specific numbers that matter. The Federal Reserve held its policy rate steady at today's meeting, declining to cut despite recent economic softness that markets had been anticipating would force their hand. Simultaneously, Iran airstrikes escalated, historically a catalyst for safe haven flows into the US dollar and Treasuries. Yet the 10-year Treasury yield rose sharply to 4.62%, up 39 basis points, which tells a more nuanced story. When yields rise alongside a Fed hold, it signals the bond market believes inflation risks remain alive. The 5-year Treasury yield sits lower at 4.35%, creating a steepening dynamic where longer duration debt carries significantly more rate risk than shorter paper. What makes today's setup structurally important is that it revives the higher for longer rates narrative that crushed growth assets in prior tightening cycles. Markets had been pricing in rate cuts later in 2026, expecting the Fed to pivot as economic data softened. That thesis is now under serious pressure. A Fed that holds with a 10-year yield at 4.62% is not signaling relief. It is signaling persistence. The Iran escalation adds another layer. Geopolitical risk traditionally boosts defense spending expectations and safe haven assets simultaneously, keeping the dollar bid even as equities suffer. This is not a simple risk-off day. It is a regime signal that the easy money environment markets assumed for late 2026 may not materialize on schedule. The sector rotation today is decisive and worth mapping carefully. Technology is the clearest casualty. The Nasdaq 100 is down significantly, with the Nasdaq 100 near lower levels, because higher long-duration yields mathematically compress the present value of future earnings that growth stocks depend on. Defense contractors RTX, Lockheed Martin, and Northrop Grumman are the mirror image beneficiaries, with Iran escalation raising both the geopolitical premium and the forward outlook for defense procurement budgets. Financials via the financial sector face a counterintuitive squeeze. While higher rates can theoretically expand net interest margins, a 4.62% 10-year yield signals economic stress that could pressure loan quality. Energy names in the energy sector are caught. Geopolitical risk normally lifts crude, but W&T offshore sits at 83.38 because dollar strength acts as a heavier headwind than the Iran risk premium can offset. There are 4 precise levels traders should be monitoring into the close and through the next session. First, the 10-year Treasury yield at 4.62%. A break above 4.70% would signal another leg of bond market selling and amplify the pressure on rate-sensitive tech and real estate names. Second, the DXY at 100.73 has defined support at 100.50 and resistance at 101.25. A clean break either direction resolves the tug-of-war. Third, gold at 4,135.30 is rallying, behaving as a pure risk-off and inflation hedge as the market digests that nominal yields are rising. Fourth, watch Fed communications closely. Any signal of a hawkish hold that keeps rate hikes on the table would send long-term Treasuries and TLH sharply lower while UUP rallies. Dovish language does the exact opposite. Dollar breaks, equities reverse. The actionable takeaway from today's Fed hold plus Iran escalation is this: position defensively and geopolitically, not cyclically. Utilities via utilities and healthcare via healthcare outperform in this risk-off, higher rate environment. Defense contractors RTX, Lockheed Martin, and Northrop Grumman carry a genuine catalyst tailwind from escalating Iran strikes. Avoid adding to rate-sensitive growth tech while the 10-year yield holds above 4.62% and the Fed shows no urgency to cut. The broader market, the S&P 500, the Dow, and the Russell 2000, confirms broad-based selling that does not yet have a clear reversal trigger. Watch 4.70% on the 10-year as the line between manageable pressure and a more serious repricing event. That is the one story that moved every desk today. Full breakdown is up. If you want this level of depth every single trading day, specific levels, sector rotations, and the macro drivers that actually move your portfolio, hit subscribe right now and turn on the notification bell. We break down every major market story before the open so you never walk into a session blind. Join the channel and stay ahead.